Welcome to Max Capital Management Global Investment Community, GIC. What is GIC? Well, let's walk through it to understand it better. Part of our Corporate Social Responsibility, CSR, we found a global investment community on March 15, 2016. To give the community member the right knowledge about investing, be it whether you are about to invest now or later. Get ahead. Start in your investing education. A home filled with experienced investors that share their insights where you hardly find anywhere else. The main perks are inclusive, gaining the time and market-proven investment strategy, property investment life cycle and business investment life cycle. It is learning from the experienced community members in various industries, learning various proven investment strategies, learning what is risk management and recovery strategy, learning why diversification is different industry and market are so important, access to global projects and businesses on top of it, a great team to support you all the way along. Here are the three main moves how MCM GIC can help you. Education, seminars and workshops has what the late Kofi Annan said, knowledge is power. Seminars are one of the best ways to get proper insights from experts in the investing world. Seminars provide you access to these experts so you can get a shortcut on what to learn and what to be aware of. MCM GIC holds almost 150 seminars globally every year, exclusive to GIC members. These include workshops, networking and site visits to connect with other members and project owners. By being a part of GIC community, members get a chance to understand the industry from the inside out and make wise decisions. Project management. Since 2012, Max Capital Management has always been providing project management consultancy to GIC members in the community with clarity. Members can easily do their project from a transparent perspective, which is reassuring. This includes investment vehicle, legal structures, tax and other aspects related to risk. On another hand, caters to wide-ranging project due diligence performance from sourcing, management, existing. Sharing ecosystem to help GIC members with their investing journey. As they learn, MCM GIC has sharing economy to help maximum usage of resources. Max Capital Management has realized that there are inefficiencies in the market and sometimes things can get unstable. Individuals may not be able to access to the right resources and resources may not be efficiently used. This is where the ecosystem comes in. Partners get connected with resources and members get maximum value being in the system. It always feels homely and safe to be part of the community because sometimes there are always hidden stories that people talk about. This factor can affect and even prevent people from making the decision they want mainly because they may not align with the investing profile and what they really are looking for. To help you more, you may also learn inside experience from investors who love to get their hand on being part of. The MCM GIC can give you access to such insights. Join the community today. Our help desk ready to serve you. If you are looking to join a knowledge-driven investment community, to learn solid investment knowledge with other like-minded investors, property investment life cycle, business investment life cycle, market industry outlook, insightful business innovation, global investment strategies, tax and legal related matters. Now you can access all this investment knowledge through our global investment seminars. Do like our Facebook page to find out more about our seminars. Our help desk ready to serve you.
us talk about this special topic about the equity investment, because most of people, when we talk about equity investment, we're actually referring to the public equity, which is public stock market. So that's a thing that most of us actually very familiar with, especially last year until this year. A lot of people actually invest in the stock market. A lot of them make a lot of handsome profits. And also some of them actually, of course, they doesn't make the profit due to certain reason, not entering into the right time. But today, I'm not talking about the public investment, means the public listed company, but we are talking about the equity investment in general, means that the whole thing, including the private equity. Okay, next is about why there is this called the equity investing, and why is it so important, and what is it so different from the investing in those scam company or money game company. First of all, as we mentioned, that zero-sum game means that actually the money is just transferring from one hand to another hand. It doesn't help the business. So whatever you invest, if let's say this is a baseless, is someone who paint the picture and tell you a very good story without any fundamental, actually most likely your money will go to somewhere else that you lose it. But today we are talking about the ecosystem in Malaysia. You see that a lot of a business, when they want to build their own business, one of the things that they require, the resource they require, is a funding. So you see, this is a chart from the SC. We have a lots of a business, they start to have build their business by actually funding by themselves. This part is actually the lowest level, which they just bootstrap their business, and then they start to test the market, they test their ideation. Then after that, they have some profit already. They use their profit to further build their business. But the issue is normally the business you build for the first 2 to 3 years, you don't see the profit. Even you see the profit itself is not enough for you to further build your business. So this company, they will go for bank and then get something, get the loan from the bank, get the financing from the bank, and get a bank overdraft from there. And then the next level they start to go to actually is go into the private equity market and get for the private equity funds and the venture capital funds to actually fund them. So basically that's something that we need to understand. Then later part, when it's mature enough, they are qualified to actually go public listed. They will go public listed in the ACE market or goes to the main market. And nowadays we have a LEAP market, which is a LEAP, which is those who are actually still not able to prove that they make money, they still can actually public list in the LEAP market. But I shouldn't say it's a public list, it's a private market. So it's still privately, but privately listed in the LEAP market. So this is a few fundamentals that we need to know. And further, we zoom into those companies who actually is new, which is a VC in the startup status. So this startup status, they actually require the fund for different area. You'll notice that when we actually zoom it down, you'll see that every different stages, we actually create the value for this company. You see that a lot of VC fund, they actually invest in this company because they want to build this company from scratch with their proven, with their validated idea. They actually go stages by stages from the seed stage, and then goes to the angel investor stage. As you can see here, the early stage, they already start to have the commercial deals with the market already. Then they'll start to go into the round A, B, C, D until they go to public listed. So that area is one of the most critical area, and most of the business actually go close down within this VC area, within the angel investing area. So that is a part we always have to be in mind, that we are actually helping, we are actually helping the business owner to actually build their business when it comes to this equity investment. All right. And there are three key things, three deciding keys that we always want to look into. If let's say you see that those rich people, when they actually start to invest into the equity of a company, there are always three things that they want to look into. First is actually about the life cycle about the equity, be it in the public market, public listed market, or be it in the private equity market. You always have to identify what is the life cycle of that business, what is the stages they are right now involved in. And with this, actually, in MCM, we actually, our founders, Professor Max Anker, founded strategy of investment through the business investment life cycle, which is to let us know what is the stages of this business and what kind of the strategy we can use for this business, and also what is the mindset that we should actually have in mind before we actually participate in this business. So we are glad to say that actually this strategy, we are nominated as the Edison Awards, Edison Awards. We are nominated, and this Edison Awards is actually one of the we so-called as a Oscar in the innovation industry. So what is about the life cycle is we actually adopt the strategies based on the stages of a business in. In other words, we are actually doing the projection. What is the next stage they are going into? What is the resources they have? What is the resources they need? And also who are the one who driving this, and who do they need in order for them to build their business? So all this strategy, all these stages is actually well described in this BILC, business investment life cycle. And secondly is about the term sheet. When we actually see the people actually involved in this private equity thing, we actually will talk about the term sheet. What is a term sheet? Is actually to clear the uncertainty, clear the things, clear the doubts, have the mutual understanding between the two parties in order to make the thing become smoother. Because if I say we talk about the documentation, we actually have the agreement, all this kind of thing is actually the background before we start with a term sheet, then only we come out with the agreement. So we can actually look into the term sheet and have a better understanding. And this part actually is more like the planning, second P, the planning, in order for us to plan for our future expectation. Then the third one is a due diligence, which is the most crucial part of anything. Even you have some business partnership with your friends, you also need to do the due diligence, and there's a lot of things to involve in this due diligence. So for now, I don't explain much, because later we have like to talk about the due diligence. And due diligence itself is actually, the first is to protect yourself, to make sure that there is no information asymmetry between you and the business owner or the project. Means that each and every one of us have the same understanding about the business, be it in the financial, be it in the future of a business, be it in the current status of a business, all this. So for these three components, you'll see that the first one is a projection or forecast of a future, or the second is a planning, the third one is a protect. So this is a 3P in the equity investing. All right, let us go through the BILC. Just now I mentioned in MCM, we always focus on BILC. If you want to understand more about the BILC, you can always read the book. Actually, MCM, we just published this book not long ago. You can actually purchase this book and understand more. In this book, actually, we not only talk about the BILC, we also talk about the PILC, property investment life cycle, because these two parts is one of the most popular and most crucial components in our investment journey. And each and every stages have a different strategy. And we also have some example that to show you that when in the startup, what kind of elements you need to understand, what kind of elements in the growth that you might not want to neglect it. In the expansion, what is the thing you can do? And in the mature, what will the company do in the future when they go public listed? So all this actually will be actually included in the book itself. And if you look at this chart, this circle, life circle, it starts with a startup. Every company starts with a startup. and then it start to grow after they validate their ideas, they start to grow. So these two parts, actually, we call it as the predictive, means that they don't have a track record for you to show during this period of time, because due to they have to test out their idea, you see that they have a lot of changes. They actually keep on transforming, keep on test the market, keep on actually produce launch some of the new products in order to test the water of a market until they actually come to a product which is well accepted by the market, well accepted not only in Malaysia, maybe some already tested in some other country at the same time. So then they will have a rough idea of what is going on in the market. Then they'll start to actually expand it with the same model, business model. They will start to actually expand it. That's why we call it as expansion. During this period, they already start to make money. Then, of course, they have to make sure they make money before they expand. So after the expansion, they will go to the mature. Means that during that period of time, you see the profit itself, they might think of with a same business model, they are not able to expand their profit furthermore unless they expand to the new market, then they still can continue. So all this actually will concluded a business, a healthy business, what they should do at different stages. Right. So the second part you can see at the lower part is descriptive. Descriptive means that we already have more than enough of information to judge whether this business can grow or not. So this is two different end of the whole spectrum of equity investment. Okay, let us go through more detail in this. So when we come to the startup, we talk about the startup. We talk about, actually we are talking about the ideation of the product. Maybe some is a product, some is a service. And maybe I also want to highlight during this period of time, we also need to see what is the business model, because they are still testing their business model. Some actually they test for the first 4 to 5 times, it failed. Then the 6th time, then they find out, okay, this is a product they would like to actually use to promote. But at the same time, some of the business, actually, they can use a business model to actually grow their business, because the product itself is that, because sometimes you can actually have a loss of a very good product in the market, but your business model is wrong. So they need to actually also test their business model at the same time. So once they go through the startup stages, then they will go into the growth stages. They find some stages that they know that this is a product or the business model that they can actually start to expand. But during the startup time, they still not make money yet, and they're losing money. But during the growth, they actually start to actually invest in it to grow their business. During this period of time, most likely they are also not making the money, but they are actually going towards profiting. They see every month they actually have a profit already, but they still not actually cover back their expenses. So we call it as a growth, because they already identify what product they are going to launch, and they want to use this product to capture the market based on what they actually study. So the next stage is the expansion. During this period, they already start to identify the business model, the product, the market, and they even actually already validated that the way they do the business, the way they market the business, they can expand using all these resources, and then they already start making profit. But during this period, the profit might not be very promising or not really attractive, but we are looking at the future with this kind of the business model and the profit. How about using the same method to actually scale it? For example, first is in KL, we start the business in KL. Next, we actually use the same method to test it out in Penang and in Johor. We believe that most likely the business will work, because during this period, those people in Malaysia, that if they accept it, is even you talk about the northern or southern region, they might also accept it. And during this expansion, people will actually start to use the same methodology to actually expand in some other country like Indonesia, in China, in Singapore, or in Philippines. Because of the Malaysia population is little, is 33 billion in population. But if I say the same thing that you can apply in the high population country, it will actually have a much more potential for you to grow your business from the today until the next level might be tenfold jump. So that's an expansion. But when the business reach the maturity, then we'll see that this business, the ability of profiting is at the bottleneck. They will know that no matter how you make the marketing, no matter how you grow your business, you actually will have faced the bottleneck and stagnant that. Unless that you actually come up with a new product or new product line, like some of the big brand, why they keep on coming up with a new product, like some of the public listed company who actually produce the drinks, they'll actually come up with a product A, then they come out with a new brand, which is a product B, and then they come out with another brand, which is product C, is because they already met that bottleneck. They know that the Malaysia population is 32 million, 33 million. So it's impossible for you to sell double of your sales if, let's say, the market mostly you already capture whatever you can do. So that's something that we call as the mature state. And there's a lot of thing to do in the mature stage, because not only you can actually expand your product line, you also can actually start to acquire some other business to expand into other industry, or maybe do some crossover. So when we actually start to participate in these businesses, we have to understand what kind of the stage they are in, and what is the expectation we need to have. Okay, we give some examples so we can have a better understanding of it. Like for example, like videos nowadays, we actually have a lot of video service provider, video streaming provider, and it's so easy for us to actually watch a video online, because there's a lot of easily more than 10 big brands in the market. Some is from even Malaysia brand. We have a US brand, we have a Hong Kong brand. So all these brand of video streaming service provider, actually they are doing very good. They are doing particular good during the period at the early of 2000, because after the dot-com bubble, actually they are doing very well. And later part, you see the players keep on coming in, they are actually entering into the mature state, and still there is a lot of competitors joining into the market. So let us use the Netflix as one of the example, and we let us examine this company, how actually they go through all these stages. So during the startup, one of the characteristics of the business is this company will not able to identify the product until it's proven that people can accept it. So the Netflix, actually at first, they are not really a streaming company. They start up their business as a rental and sales of a DVD company. Why they start up the DVD company? It is because DVD actually just newly launched on 1997. Because of the launching of that, they want to tap into the wave of this DVD, because everyone talking about the DVD. So they think that it's very good time for them to expand. So they start up a company, Netflix, and then they do the sales and the rental. And then they, after a certain time, they find out that sales and rental, the rental actually contribute to more than 70% of their business revenue. But for the sales, actually, it seems that people during that time, people tends to rent rather than buy it, because buy it, you can watch for a few times, then you just leave it there. So they started to allocate their resources to actually focus on the rental business. So during the startup, they actually switched their business model for some time. And then later part, they find out that actually during that time, they spend the 10 years to go through the startup, they go through the growth, and they start to expand. Only after 10 years, they expand to the China market, they expand to some other countries. But during that period of time, they also noticed one thing, because rental itself, actually, at first, they are very profitable. But during the growth stage, after 7 to 8 years, they see that the revenue start dropping. So what they do is they start to identify what is the thing that the market needs. So during the growth, they actually start to capture the market. They always think of what is the strategy for them to capture the market as soon as possible. Then comes to the 2007, which is after the dot-com bubble, after the streaming, the technology actually have evolved tremendously rapidly during that time, and the streaming technology become mature enough. So they start to jump into the bandwagon to actually adopt the streaming methodology. So they actually use this methodology for the next 7 years until, I think, until 2012. During this period of time, they grow tremendously. But during 2012, they start to see that the streaming itself already not able to satisfy the people. Even they do the expansion, some of the country, they're actually doing not really well. But they see that that is some of the trend that the people are not easily satisfied by just stream it, because they can actually go on board to your platform to actually watch your video. But at the same time, there are so many competitors out there in the market that I can jump on board to other platforms which actually have the cheaper subscription. So what they do during the expansion period is they actually solve this issue by actually creating another service, is their in-house production series. Means that if you want to watch this video, you only can actually watch this in my platform. You can't actually see this in elsewhere. So that's why you can, I think everyone talked about the Squid Game recently. Everyone talked about the Queen's Gambit previously, which is very popular last year. So these two movie series, these two series actually is produced by their in-house production from the Netflix. If you want to watch this, you only can actually watch at the platform of Netflix. You can't actually watch it elsewhere. So that's something that they start to expand, but they're already reaching the bottleneck, which is at the age of a maturity. But if let's say they still keep on encountering this kind of issue, they might actually also expand into some other area which will be synchronized or maybe have a synergy with this business. So that is a mature stage. I give another example is the Amazon. Amazon at first they start up as a bookstore, online bookstore. They sell the books. After a certain time, they think that this area can grow, but actually it's limited. Then they start to sell CD, and then they grow to some other country, because some countries actually they prefer to read a book online, but some of the country is very difficult for you to penetrate in this industry. So they actually start to actually sell other things. But later part, after 2007, they actually expand into China, because China have one of the biggest consumer market, and then they also expand into some other area. Right now, they are actually the largest marketplace in the world, that they can basically sell anything. But maybe some of you might know that actually Amazon is not really a marketplace anymore. They are actually the ecosystem. Not only the marketplace itself, I see that they also actually doing some of the web hosting, like the Amazon web hosting, AWS. They're actually selling the clothes. They actually, during the 1999, they also start to actually transform to have the one-click purchase. Means that they want to make sure that everyone can purchase the thing easily without actually keying the credit card, without actually going through the hassle of getting all the validation. So they developed one technology, they call it as the one-click purchase technology, which is patented. And then they use this to expand. Not only they use this technology, they actually roll it out to some other merchants to actually use it together with them. So this becomes the ecosystem. So this is the best explanation of when we go through the startup, we have to accept the fact that this business will keep on changing their direction. Unless that they already found the validated this idea, then they will stay. If not, they will have to continue. And especially during this period, even like the Netflix, even the Amazon, during the startup and the growth, they will encounter a lot of the challenges of the business. They will encounter the tax issue, the encounter of a sales issue, they can encounter some of the competition in the market. They have to overbid them in order to capture the more market. So this is the stages that commonly we'll see. But when they enter into the mature stage, we will see these challenges lesser, because they already capture the market and they are actually strong enough to fend off the competition. and at the same time, they are actually strong enough to expand to some other area. Just the only disadvantage is they are not agile enough for them to switch the direction. So different stage have a different advantages for us to look into. And next is a term sheet. Because of the time issue, I will actually not talk about the term sheet, but just an explanation. Term sheet is the non-binding agreement. Before you actually enter into the participation of that business, you have the non-binding agreement, and it serves as a template for you to discuss with the party that actually work together. You want to work together with. Is talking about the legal, about the finance, and inside the term sheet that involve a lot of different components. But most importantly is the identification information, because you want to know the business. Sometimes we in conversation, we might have lots of misunderstanding. But when we write it down clearly in what in the term sheet in an easy format, it's not a long agreement format, then you can actually capture the information easier, and the amount, the percentage, the time frame of your participation, what is your voting rights, and what is the conversion option, how you actually convert your stake in the business, and how is the anti-dilution work if let's say you are really mind of your own share being diluted from the future investor, and the right for the future investment, and also the founder's obligation, because you need to actually you need to limit the power of the founders to do whatever he wants. So there's an obligation that you want to set also. And sometimes some of the business is actually there is a lot of trade secret. We also need to include the non-disclosure requirement in order to limit us what is the information we can share out in the market. So that's the term sheet. And the third thing is the due diligence is also one of the most important part that you want to know, because first the life cycle, you already actually set your direction, you know what you need to do. But the next thing you might want to do is a due diligence. So due diligence is something that you want to investigate, you want to audit the company, and you want to review and see whether this company is it aligned with your participation, your investment direction or not. So this three is something that you want to make sure that you are into the right business. And it required lots of effort for you to actually investigate. For example, there is this 6 types of a major due diligence you need to do. First is the purpose, whether you invest in something that actually is illegal in your country, or maybe this business is something that can generate the thing that you want in the market, because sometimes it's not aligned with what you want in your life, because that's a philosophy of investment. So we need to know what is this business all about. Is this business helping the market to improve or become a better place? That's something that we want to look into. Secondly is financially, whether it's sound or not, or there's a lot of the hidden agenda when they actually raise a fund, or maybe when they actually have this issue in the financial standing. We also want to dig it up, and whether they're actually facing the cash flow, which is solvable by the funding or not, or they just have some other thing that we not disclosed yet. So we actually have to check it out. The third is legally. I believe that most of you see that some of the business, actually they have a very good business, we call business pinpoints that they can solve. But the solution itself is not accepted in that country because it's illegal in that country. So this whole business collapsed just because of that. So you might actually do a very good due diligence in the purpose due diligence, financial due diligence, the risk due diligence, but the legal itself have to always be intact with whatever you involve in that country. The fourth one is the business plan, or we call it as a business model. Is this business model a conventional one, or is a disruptive one, or maybe is an untested one, which we also don't know whether it will work or not. So your investment strategy and your expectation might differ. Because if let's say that is not tested one, so you have to consider it as a very high risk type of business, and the business model and the business plan itself. The fifth one is the risk what is the systemic risk? There's a lot of the different type of risk. One is a systemic risk, which when it design the business itself, this is a risk involved in the business structure. So we call it as a systemic risk. And the last one is the progress. Because after you do the due diligence, you partner, you already participate in the business, this business will grow and it will change by times. Maybe after 3 months later, they switch the direction. After 1 year, they will switch the direction. Later part, they will switch again. So you have to always monitor it and understand what is the standing of a company. So that's all for the 3 category, the 3 keys that we might want to actually understand before we participate in this kind of the equity investment. So thank you very much.